Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time, but we did want to take note that the TSX has hit 32,000, actually 1 point above that right now. So it will be a record close if it doesn't lose from the higher end here after two record closes last week as well. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. The Prime Minister, Mark Carney, has named Mark Wiseman as Canada's ambassador to the U.S. He'll start in February, and he succeeds Kirsten Hillman, who will be stepping down in the new year. Wiseman is a former BlackRock executive and has held senior roles at some of the country's largest pension funds. Carney's government is prepping for a review of the Canada-U.S.-Mexico trade agreement, which the U.S. has said it wants to change. Canada's housing minister, Gregor Robertson, says Ottawa will consider changing the foreign home buyers ban. Robertson telling Bloomberg Canada needs to ensure housing is built for and owned by Canadians first, but Ottawa needs to figure out the best role for offshore capital in the housing market. Ottawa will consider changes beginning in 2027. We're watching shares of Altius Minerals and Lithium Royalty today. The Canadian-based explorer and developer is acquiring lithium for $520 million. Under the terms, Altius will gain ownership of 37 new royalties, with the vast majority of the assets located in Canada, Australia, and South America. The acquisition will also create a significant pipeline to the battery metal components of its business. Shares of Baytex Energy moving higher after the company unveiled its targets for 2026. It plans to spend as much as $625 million in exploration and development and is expected to generate production growth of 3 to 5%. The company says first quarter production is also expected to average up to 69,000 barrels of oil a day and then ramp up to 70,000 by the end of the year. And as we just mentioned, the TSX has moved up beyond 32,000. That is a new record high. It's up about 0.8%, but it's a 250-point move, so 30,006 is where it stands right now. Let's move south. The S&P 500 gaining 44 points, or 0.7%. The Dow Jones, a 252-point move up, about 0.5%. And the Nasdaq, a 118-point move, again, a 0.5% move up for the Nasdaq. North American index is trading higher today as investors get a little more optimistic about the Santa Claus rally that has started. Gold and silver also getting to all-time highs, driven by expectations of more rate cuts and then a weaker U.S. dollar in the new year. Let's go to Brooke Thackeray on this, research analyst at Global X. Brooke, we just saw the TSX climb past 32,000. Would you have anticipated that at the start of the year?
No. I mean, the Canadian stock market's done extremely well. You know, we've seen Canadian banks do well for so much of this year, and we've seen the gold miners also do well. And that's what's boosting the Canadian stock market today.
Let's talk about gold and silver. Are they overbought?
You know what? From a technical perspective, it's hard to argue that they're not overbought, particularly silver. But we see some strong fundamentals that are driving this, and the fundamentals aren't changing. We're seeing central banks to continue buying gold into next year, probably. I mean, there's no signs of them slowing their purchases. Investors are worried about currency debasement taking place. And we've seen a real attraction towards silver as well. And there's been a structural deficit for silver for the last 4 years. So investors are really liking that sector right now. And compared to earlier in the year, where silver was extremely cheap relative to gold, when you look at the gold-silver ratio, when around April it was around 100, now it's dropped down to 65, which is kind of normal. But we've got a lot of tailwinds for gold and silver to continue to move higher.
Okay, talk to me about the Samsung plans, or what they have in or coming down the line that could affect the price of silver moving on in the new year.
Yeah, so this was a really strong, a really small announcement last week. It really wasn't picked up by the media very much. But Samsung signed a $7 million deal to prepaid takeaway deal for La Perilla mine in Durango, Mexico. What that does is it ensures them 2 years of production from this mine. Now, silver, that's $7 million is a really small deal for Samsung. But I think they're trying to get their feet wet because we're going to see more and more of this happening where companies are going to try and source their own production of supply materials. In the case of Samsung, they're working on a solid-state battery, which is supposed to be absolutely amazing, 3 times as dense as what the current batteries are, 900 kilometers charge distance, charge in 9 minutes, longer battery life. It goes on and on. So it's an amazing battery, and they're planning to roll this out slowly. Not to get everybody's hopes up, starting in 2027 plus with some really high-end cars, and roll that out really in the 2030s to more mass market. Now, if that happens, that is a real game changer because each one of these solid-state batteries contains, on average, 1 kilogram of silver. So if you took all of the silver in production today and said, well, how much of that would have been used in 2025 if all the EV cars had 2025 cars sold had silver batteries, that would have been half the production. So we're seeing a lot of this happen where governments have come up and bought critical minerals. We're starting to see, I think, companies do the same thing. So I think it's a small announcement, but it's an important one.
Okay, let's get to tech with a bit of a rebound after what seemed like a correction in November. Anything spurring that you see?
Yeah, this is all about the narrative with tech. Tech got way up on the AI story, and all of a sudden everybody started to question and say, well, do we have enough data centers? Do we have enough energy? Do we have enough water? Do we have enough financing is the latest. So we saw Blue Owl pull out of its financing deal with Oracle. Now, they had done previous financing deals with Oracle, but they pulled out of this $10 billion data center deal. And next year in 2026, it's going to be a lot about, is the money there? Is it profitable? Because these companies are actually borrowing, so not using free cash flow to expand on AI. Look, the AI story's here. It's going to change the world and it's going to grow, but it's going to be so bumpy. And we're seeing a lot of questions around AI. So I think that could be the big story. Another big story next year is that investors start to rotate more away from the technology space and look for other sectors of the market. I think we've seen that already a little bit in 2025. We've seen the metals and mining sector do well. We've seen gold and we've seen silver do well. So I think we're going to see more of that. And that's a healthy sign, actually, with the market broadening out. It doesn't mean the market's going to crash. I think we could see just broadening out to other sectors, such as the small cap sector as well.
Okay, so not really broadening out necessarily to other tech plays, but broadening out more to things beyond tech.
Yeah, absolutely. I think, there's a lot of exciting tech stories. I'm not trying to deny that, and technology will change our lives. But I think investors are going to be rotating to other parts of the market. I don't see them rotating into the defensive sectors, such as consumer staples and healthcare very much. I think they're going to be more into the cyclical sectors rather than some of the growth sectors.
I also want to get your thoughts on the Paramount Warner Brothers storyline, which is ever changing. Now we have Ellison backing an offer, but do you think that'll make a difference? It seems like Warner Brothers is pretty set on Netflix taking ownership.
Yeah, it's hard to tell because a lot of this is gamesmanship. Paramount was trying to court Warner Brothers before Netflix stepped in. So this is, and then Netflix stepped in, and now we've seen Paramount come in with their offer. And the problem with the Paramount offer was it was very opaque, and it was hard to see into like a family trust, et cetera. And so the financing was uncertain. So we saw Larry Ellison step up and commit $40 billion or pledge $40 billion on this deal here. I think that we're going to see Paramount come back and probably put in a higher offer. I think they really want this deal. It's hard to measure the two competing bids because Paramount wants a whole company, whereas Netflix just wants the streaming business. Basically, they don't want CNN. They don't want TNT, the cable business, as well. But I think we're going to see Paramount step back up here again. This was just another step in the whole negotiation play here. Okay,
I guess we'll see. We'll have to wait and see how it all does play out. Investors, of course, will have their say as well. Brooke Thackeray, research analyst, Global X. Thanks for joining us.
Thank you.
Coming up next, we'll continue our conversation on the record run for gold and silver with TD Securities Head of Commodity Strategy, Bart Mellick. Back in a moment. The CPI index is reporting that salaries have been steadily increasing over time. But when it comes to hitting some of their financial goals, many young Canadians still feel left behind. We're joined by Hanif Bayat, founder and CEO of Wawa Leads, and we kick things off with an overview of his company.
We are a personal finance platform with more than 1,000 guides, calculator, and content that more than 500,000 Canadians come every month to learn about mortgage rates, GIC rates, or like incentives, tax, and everything about personal finance.
And Generation Z are people who are typically between 28 and 16.
Yes, these are the people who typically looking for entry-level jobs.
Okay, so they're pretty young.
Yes.
You say there is evidence that, for one, I mean, CPI inflation numbers indicate that, sure, incomes have kept up with inflation over the years, but you say that hides an important component when it comes to accommodation, housing. Tell us about that.
Exactly. So when we typically, when they try to evaluate the present value of the income, they use CPI inflation to see that what was the value of the income, for example, 20 years ago. But there is some problem in it because not 100% of the income goes for living a life or consuming products. Actually, a portion of that goes for building a life. Building a life is a bit different than living a life. So when we look at this, the CPI is looking at like your grocery stores, like shelter, internet, your costs that you need to survive and live a life. But in reality, you need to save for retirement. You need to, many people need to buy assets for financial stability. And when it comes to that, you see that the power of median disposable income actually decreased since 2000. So what we did in our studies, we said that, okay, make an assumption. 80% of the income goes for consuming products. So we use CPI for that 80%. But the 20% goes for saving, and saving happens...
Should be. 20% should be saved.
Yes.
Yeah, okay, sorry.
Should be. So 20% should be like 15 to 25%. So we assumed like 20%. And we assumed 3 different asset classes. So first case was the average home. Second case was the S&P TSX, a net total return. And the third one was the precious metal. In our case, was gold. In all 3 scenarios means that we assumed still 80% of the income goes to consumer products. So you use CPI inflation for that one. But for the 20%, we use asset inflation. We see that actually the power of median disposable income has decreased since year 2000, slightly.
Now, just zero in on mortgages and the principal repayments of mortgages. You argue that it's not fully reflected in CPI numbers?
No, in CPI, actually, there's nothing about principal payment.
Okay.
So in shelter component of the CPI that is tracked is mostly on focus on rent and also interest payment. Interest payment, you don't pay the principal. Okay. So it's for living. It's not about that you're accumulating assets. So that's the problem part. So when they, no one should use 100% of their income to, to consuming product. You need to money for, for uncertainty, for retirement, for many different things. And that 20% that is assigned, you see that the poverty has decreased significantly in the last 2 decades.
So people between 16 and 28, it's not a myth that they've been falling behind economically.
Not at all, in my opinion. Because some people come and said, oh, you see the median income based on CPI actually slightly increased. But there's as I said, there's a bit misleading because no one should spend 100% of their income in consuming product, and they want to buy home, they want to buy asset stocks, and actually that freedom give them an ability to do more risk. So when these people are they cannot build a life by buying asset, actually they become more conservative, and that itself will add another factor to make them, they feel behind because they cannot, decide to do a risk like start a business or something because for that you need at least some money, some buffer, and this is what we did we have seen it, and this generation. They're under pressure in different areas. It's not only this one, but this is one aspect that even if they find a job, the job payment is not as good as before for building a life. But this is not the only thing. When we look at AI, AI is disrupting everything eventually. But currently, as of this moment, it's disrupting entry-level jobs. And these entry-level jobs, who is looking for them? Gen Z. For example, firsthand, myself, I have seen that in our company, we had interns in programming, computer programming, that are very qualified. They have been very qualified, and previously, these people were finding jobs very easily. And I've noticed that some of them are in the market for more than 1 year, and they are good from good schools, good grades, even had internship. And this is something that I have noticed. I'm shocked at how struggle with the entry-level jobs. So it's not only even they find a job, the power of income, besides that, even the entry-level job has impacted heavily by AI.
That was Hanif Bayat, founder and CEO of Wawa Leads. We're going to take a quick break. Back in a moment. It has been a year many in our country have come together, united by a common goal to stand up for Canada. And that includes the premiers of the provinces and territories, Team Canada, who came into focus in 2025 on the front lines of the trade fight. As CTV's Andrew Johnson tells us, however, old interprovincial rivalries were also renewed.
In a year that started out looking like this.
I think Canada is going to be a very serious contender to be our 51st state.
We're going to put very serious tariffs on Mexico and Canada.
Canada's premiers, the faces of each province, became a focal point of resistance against Donald Trump's trade threats.
As Canadians, we need to realize that he is not joking.
Each standing up to defend their provincial and territorial economic engines on behalf of Team Canada. An early move, all but two, opting to remove U.S. liquor from store shelves. Manitoba's Wab Kinew took a page right out of the American president's playbook.
It's a wonderful order. It's a beautiful order. This order is pulling American booze off the liquor mart shelves.
At the White House in February, the premiers met with members of the Trump administration, presenting a united front.
The worst thing we could do as a country is not show up.
For Ontario's Doug Ford, showing up meant going on the offensive, threatening to punish America by any means possible, including restricting power sales.
If the United States escalates, I will not hesitate to shut the electricity off completely.
Ford even urged Alberta to put an export tax on oil.
Their gas prices go up 90 to $1 a gallon. They will lose their minds.
That did not sit well with Premier Danielle Smith, who called the idea absurd and self-destructive.
You can ask me as much as you like. The answer is no.
Smith, who'd been criticized for visiting Trump at his Mar-a-Lago home in January, said diplomacy, not retaliation, was the best way to deal with the president. The Team Canada narrative was also interrupted in May when supporters of Alberta separation celebrated a Smith government bill that would make it easier for voters to force a referendum. Smith said she didn't support separation, but also wouldn't stand in the way.
I will respect the outcome of citizen-initiated referenda, and that's why it's my job to make sure it doesn't get to that point.
I want to welcome everyone.
By summer, 6 months into the trade war, premiers and territorial leaders were in Ontario cottage country, talking trade, tariffs, and teamwork.
Right now, our economy in all Canada suffers because of the uncertainty.
Another goal of the 3-day summit was to make it easier to move goods between provinces at a time when many discovered buying Canadian could be difficult.
I can't say how many times I've heard it's easier for me to access Alabama than Alberta.
In late September, Trump again turned up the heat, announcing new tariffs. Ontario's response got under the president's skin.
When someone says, let's impose tariffs on foreign...
A $75 million ad campaign airing on major American networks starring former President Ronald Reagan.
Over the long run, such trade barriers hurt every American worker and consumer.
Trump called the ad fake and promptly ended Canadian trade talks.
They did a crooked ad. They knew it was Ronald Reagan loved tariffs.
Ontario ended up pulling the campaign early, but the man who authorized it was downright Trump-like in declaring its success.
It was the most successful ad in the history of North America.
It was around this time cracks in the Premier's Team Canada collective widened out west over Alberta's pitch for a new pipeline to send bitumen to BC's northwest coast. Despite a hard no from BC's David Eby, Danielle Smith pushed to have the proposal added to Mark Carney's major projects list.
Premier Eby's comments are un-Canadian and they're unconstitutional. All it takes is the Prime Minister to say yes.
It's not the Danielle Smith show, it's the Canadian team. And we all deserve the same opportunity for the same federal funding for our projects as she does for hers. That's not un-Canadian, that is fair.
Smith got what she wanted, a memorandum of understanding signed by the PM.
I think it's going to unleash an incredible amount of investment.
As 2025 comes to a close, with Canada and the U.S. still deadlocked on a trade deal, we can expect a continued focus going forward on the premiers, advocating for their provinces and territories and trying to get along. Andrew Johnson, CTV News, Vancouver.
All right, let's have a quick look at the markets ahead of the end of the trading day. As we started the show, telling you the TSX has moved above 32,000 at one point today. It's dropped below that now, 31,976, but still in the game for a record close on this Monday. The TSX up 30% so far this year and has made a 226-point move up today. So we're watching that pretty closely. Just to look at the year so far, materials moving up 105% year to date. So it's up 2.32% today, $161 move up at $7,125. But materials, the best performing sector so far this year. And that's followed by financial, second best sector. It is up 31%. So quite a big difference between the leading sectors. But the financials is the runner-up here in the best sector. Consumer discretionary is the third, with a gain here of almost 30%. The end of day numbers when we come back. Stay tuned. MRR, sorry. And thanks for joining us on The Close. Here are the end-of-day bells. At the NASDAQ, KKM Financial ringing the bell. In New York, Global X ETF ringing the closing bell. You're watching The Close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite has another record close, 32,000, almost flat, a 244-point move today on Monday, 0.7, almost 0.8%, we'll say. The S&P 500 also gaining today. It's a 43-point move up, 0.6%. And the NASDAQ gaining as well. It's a 121-point move up for the NASDAQ, about 0.5%. Let's look at the movers in Toronto. We'll start here with Bitfarms. It moved up 6%. That's again a 22 cents to $3.71. That's a cryptocurrency mining company. So it was a gainer today. It's up 52% on the year. Let's move to the precious metal stocks that were movers today. Discovery Silver up almost 8%. It's up over 1,000% this year, 1,200 in fact. Again, at 67 cents today, taking Discovery Silver to $9.07. 5N Plus, also a mover. They do cadmium and zinc. They gained 4%, 74 cents, taking the stock to $18.60. They're up 161% over the last year. And then Lundin Gold, also a mover today. Gold also hit a record high, so Lundin moved up almost 6%, a gain of $6.77 to $120.46. Now, on the flip side, Curaleaf moving down. This is a cannabis company. It's been bouncing around a lot with news out of the U.S. It's up 80% on the year, but down today, 7.5%, taking the stock to $3.83. So stocks, of course, aim to finish the year strong following the recent volatility. My next guest remains confident the market has more room to run. Let's go to Jay Hatfield, founder, CEO, and portfolio manager at Infrastructure Capital Advisors. Thanks for joining us today.
Happy holidays, Marilla.
Thanks. Same
Thanks
to
for having
you.
me on.
You're bullish on stock for the next year. What feeds into your theory?
Well, the most critical factor actually occurred last week when we got the CPI data. We're optimistic on inflation and were before that report because the shelter component is finally, because in the US, we have the worst calculation of shelter inflation in the world. So we're leading the world in bad calculating, in that our measure is 2 years lagged. But in the last report, it got way closer to what market rates are. Market rates are pretty close to zero for rents in the US. And we were at 0.1 for 2 months, so it's 1.2. So as market collapses to, or as really the historical poorly measured collapses to actual, we'll get inflation down to 2, the Fed will cut 3 times, rates will go below 4, 10-year will go below 4, and that's supportive of a 23 times multiple, which is admittedly a full multiple, but not above historical averages when you correct for corporate taxes. So our target this year was 23 times next year's earnings, and then our, so it's 7,000 targets. We have a little bit of upside from here. And then next year, we're at 8,000, which is 23 times S&P earnings for 27.
Okay.
So we think those are reasonable targets supported by strong earnings growth, likely acceleration in the U.S. economy as rates come down and the housing market recovers.
Okay, so you're building in here a corporate tax cut. What about without one?
Well, what I meant by that was it's perfectly reasonable to say, oh, well, 23 times, that's patently ridiculous because the 20-year average is 18 times. But what people miss is that the corporate tax reduction in the U.S. was profound in that we went from 35 to 21. So it's just like if your real estate taxes were eliminated and it's only your house and not everybody else's, then the valuation of your house would go way up. So we estimate that increased the sustainable multiple on the S&P by 4 points. So 23 is only 1 point above the corrected average.
Okay, let's get to sectors that you favor for 2026. We saw the AI run, of course, this year. We saw the metals run this year. What are you looking at next year?
Well, we would, because we're bullish on both rates and on the market as a whole, we would be risk on. So that includes in fixed income, should be in high yield and preferreds. We have 2 funds, BNDS and PFFA in those sectors. But we think they'll beat investment grade substantially if we're correct about the market being strong. And then with regard to sectors, pretty much the same ones we had recommended this year. So financials, industrials, still tech, although we think tech won't really beat its risk-adjusted returns, and also consumer cyclical. So more risk on, just like what really worked pretty well this year, although tech was the leader among those. We think the other 3 will do better. So be out the risk curve. We don't think there's any chance of recession, and we're projecting 3% growth in the U.S.
Okay, so let's go through a few specific picks. In financials, there are a couple you like. Goldman Sachs is one, Morgan Stanley's another.
Absolutely. So we do think, although they're not as cheap as they were when we recommended them 2 years ago, the ongoing investment banking boom will support those stocks. And specifically, you've even seen that this morning, there was a couple of LBOs, been some gigantic IPOs. But we also do like some of the private equity firms like Apollo and KKR because they benefit from the IPOs. And they also became discounted because we think investors massively overreacted to a couple of bankruptcies that we think were one-off and not really cockroaches.
Okay, so let's get to Broadcom, which you like. Tell me what you foresee for Broadcom.
Well, we do think that there's substantial upside that was actually recently created. So our target is about 420 where it peaked out, but it really went on sale for no particular reason. It reported pretty strong earnings. So we do see substantial upside now into that area. So we had been selling it when it got to our target, and then we've been buying it as it got down to the 330 area. So, targets are not just for promoting stocks, it's also you're supposed to sell them when they get close to the targets.
Okay, so I do want to get to your next pick, which is Amazon in the tech space. With the Magnificent Seven, are you sort of spread out at anything else, or is Amazon sort of your focus?
Well, we think the others are pretty fully valued. We do like Marvell, which is like a Broadcom competitor, but on the Mag 8. We call it 8 because we include Broadcom. But Amazon's pretty interesting in that it hasn't really participated in this tech rally. And it's more consumer cyclical, which should do well this year as there's rotation away from just the Mag 8. And what's unique about Amazon is they have a gigantic amount of sales, but not earnings on the retail side. And they're 100% focused on making that profitable. They're going to benefit from robotics. They've moved inventory closer to customers, which if you're a customer, you'll quickly realize because you get it a lot faster, but it's also cheaper. They're doing advertising. So we think that cost-cutting strategy has been underappreciated, partly because it is about half consumer cyclical. So we think it's going to do better relatively even to the Mag 8 next year than it has this year. It's really lagged. We do have a 300 targets. We see substantial upside.
Okay, I've got to leave it there. Jay, appreciate you joining us today. Jay Hatfield, founder, CEO, portfolio manager, Infrastructure Capital Advisors. Coming up, who will win the battle to control Warner Brothers? Back in a moment. There is a sense of uncertainty among dairy farmers as Canada looks to renegotiate a new trade deal with the U.S. and Mexico. CTV's Jeremy Sharon has more.
Does this 24 hours a day, 365 days a year. For more than half a century,
I've been doing this, my whole life, but I took over from my dad in 1992.
Dairy farmers like Peter Reuter have been protected.
When you drive by my farm, know that behind the door there's a farmer like me producing the milk to their standards that they want, healthy, pure, and local.
Canada's supply management system means the industry and its producers are afforded certain safeguards. Quotas and minimum price guarantees ensure stability and predictability. Supply management also protects the domestic market, limiting import access.
It's not competing against the American producer, it's competing against American subsidies.
But in dairy farms like this one across the country, there is a sense of uncertainty. Concern over what CUSMA renegotiations in 2026 could mean for the system that local producers have long been accustomed to.
There comes an end point where it's not worthwhile to, give up that much market share. So we can't give up more.
This week, U.S. Trade Representative Jamieson Greer told Congress the dairy industry would be a priority in upcoming trade negotiations. Under the current agreement, the U.S. gets tariff-free access to about 3.5% of Canada's dairy industry. They're pushing to expand that. Prime Minister Mark Carney has repeatedly said supply management will never be on the table in negotiations, a position he stood by when asked Friday.
Not on the table. We'll continue to protect supply management.
In a statement to CTV News, the president of the Dairy Farmers of Canada says they expect this commitment to be honored as the CUSMA review process continues. But here on the farm, the threat is hard to ignore.
If anything were to happen, it'd be vitally impossible for me to continue.
A harsh reality Reuter and the dairy industry as a whole hope they won't have to face.
Compared to the U.S. farms, I'm miniature.
Jeremy Sherrill, CTV News, Ottawa.
And when we come back, who will win control of Warner Brothers Discovery? A new move from the Oracle CEO. Back in a moment. Amid the rush to finish up holiday shopping, new reports find many Canadians are choosing to spend less this year. Families are looking for savings just about everywhere, except for one spot. CTV's Colton Creel has more.
It's the season of giving.
Merry Christmas!
But some Canadians find themselves giving
less. And you can do it if you're good at knowing what the prices are.
A new survey from TD Bank found more than a third of Canadians are cutting back on holiday spending, up from last year.
Me and my partner decided actually not to exchange gifts between the two of us this year. It's so expensive.
It's not just presents under the tree that are getting trimmed. According to TD, of those planning to save this holiday season, nearly half are cutting back on social spending.
Especially with groceries are way more expensive, so it makes like hosting and having parties a lot harder.
But even as holiday budgets decrease, 46% of people are actually spending more money on Canadian products, according to Business Development Canada. At this Ottawa artisan shop, that's leading to a boom in new customers.
When folks can check all the boxes and they're not draining their bank account or taking out loans just to support the Canadian economy, then it's a win-win.
Still, according to TD, over 3/4 of Canadians admit they're vulnerable to overspending on the holidays, feeling the pressure to create memories or spend extra to give meaningful gifts.
It is something we're willing to pay for because we really want to support Canadian producers and makers of products.
According to a report from Business Development Canada, if families spent an additional $100 of their expected holiday shopping on Canadian products like this one, the benefit to the national economy could be as much as $2 billion.
CTV's Colton Creel reporting. After Warner Brothers board endorsed Netflix offer over Paramount's, Oracle CEO Larry Ellison stepped up. We'll have more on that story in just a moment. Another twist in the bid to own Warner Brothers Discovery. For more, let's go to Molly Schutz. She's Bloomberg team lead for U.S. technology and with a focus on media, entertainment, and telecom. Thanks for joining us today.
Hi.
Why did Larry Ellison step in?
Well, I think basically he stepped in because the Warner Brothers board had said the other day in rejecting Paramount's hostile takeover bid that they didn't really think that the financial backing was solid, despite the fact that Larry Ellison is the world's 5th richest person. The language in their offer included a revocable, a backing of the family's revocable trust, and so the board took issue with this idea that this is a revocable trust. So Larry stepped in and put his name on the bottom line, personally backing $40 billion in equity financing as part of this deal, in an effort to try to convince Warner Brothers board that, look, this money is good here. It's solid.
Okay, so obviously, as one of the world's richest men, if not the world's richest, he wanted to step in and say, look, I'm backing this deal. But will it be enough? It kind of looks like Warner Brothers is looking for an out here.
So this is the big question. The ball now is in the court, basically, of the Warner Brothers shareholders. They have a couple weeks to be able to decide whether they want to tender their shares to Paramount, to Larry and David Ellison through Paramount, and tender their shares, even though the Warner Brothers board has encouraged them not to, and to stick with the bid that they have, the deal that they've already signed with Netflix. So Warner Brothers board is encouraging shareholders to just stick with that and telling them that they think that's the better deal. So we'll have to see if they come back and change their mind after Larry Ellison stepped in.
Okay, so at this point, I guess we're waiting for, as you mentioned, the board to assess this new backing of the financing and decide what they want to do?
Right. I don't think that they necessarily have an obligation to come back because, like we said, they've already agreed to a deal with Netflix. But shareholders will be able to decide what they want to do. And, the board could come back and say, yeah, we want we changed our mind. We think this definitely looks solid, and we think we should go for this, in which case they would have to pay Netflix a $2.8 billion fee for dropping the deal with them. So there's definitely things they're going to have to consider on both sides.
Okay, and just remind us, Molly, because one offer is to buy the whole shebang, but the other offer, the Netflix offer, they don't actually want the television stations, for example.
Right, that's correct. So before this kind of very public takeover battle even came about, Warner Brothers had decided it was going to split itself in two, essentially, and spin off its cable and linear television assets into a separate company. So you would have the Warner Brothers studio and HBO in one unit, and then the linear TV and cable assets, including CNN, in another. So those are still going to get under a Netflix deal, those would still be spun off into a standalone company, and Netflix would take over the Warner Brothers studio and an HBO and the streaming assets. If Paramount wins and Larry Ellison and David get their way, they will buy the whole company, including the cable assets as well.
All right. We will leave it there. Molly Schutz is with Bloomberg. Thanks for the update. Appreciate it.
Thank you.
All right, let's get some more reaction and break it down with Matthew Dolgan, senior equity analyst at Morningstar. Thanks for joining us today. Let's talk about the personal guarantee from Mr. Ellison. Do you think it's going to make a difference to Warner Brothers? As I was saying, it kind of looks like Warner Brothers is looking for an out because they want to go with Netflix.
I agree with you completely. The Warner Brothers board was looking at multiple reasons why they said they didn't want shareholders to approve the Paramount deal. So, no, we don't think that today's developments will change how Warner's board is looking at things at all. Your reporter, Molly, was exactly correct. Right now, this is in the hands of shareholders. And so we doubt that today's developments really make a big difference to their decision either, but it could at the margins. And so right now, it's up to the Warner shareholders to decide whether they want the Paramount offer for $30 a share, which they can vote on directly, or to not tender their shares and wait to vote on the Netflix offer later. And really, that's the only thing that we think today's news will influence. We don't think that we're going to see any revision from the Warner board on what they recommend based on the standing Paramount offer right now.
Okay, can you give us just the broad strokes on the offers as they compare? Because when you look at them, we know Netflix has a lower offer, but they don't want to take the cable TV stations. So it's hard to sort of compare them just on what we see.
That's absolutely right. These are not apples to apples offers, and therefore it's not such an easy decision or an objective decision to compare them. And so when we hear about Paramount's grumbling that Warner didn't accept the best offer, that's really at this point up for debate and in the eyes of the beholder. And we think there's no way that the board, Warner's board, could be considered deficient in choosing what they did. As far as the offers, Paramount's is pretty simple. They're offering $30 per share in cash for the entire company. So Warner shareholders will just collect $30 and be finished. They take their cash and they have no remaining stake in the company or any of the company's assets. And one of the questions supposedly from the Warner's board was how good that money is, how firm the deal is. And that's what today's revision from the Ellisons maybe cements a little bit more that, yes, this is money good. Should the deal get approved, you get this $30. Netflix is different, of course. You mentioned they don't want the entire company. So their offer was for $27.75, but leaving shareholders the remaining global networks, the linear networks, which value estimates can vary. We think they're worth about $3 a share. However, there's going to be a lot of debt on that remaining company, and it's linear television network, so it's a business in decline. There could be risk there. The other part of it, the $27.75 that Netflix is offering for the streaming and studios business that they want to merge with, $23.25 is in cash. The other $4.50 is not certain to be $4.50. It's based on Netflix's stock price, and if Netflix's stock price is below about $98, it's going to be worth less than $4.50 and worth less and less the lower Netflix's stock price goes. If it happens to be that Netflix's stock price is above like almost $120, they'll actually get more than $4.50 a share, and this is around the time of closing. But they'll have a remaining stake in Netflix, and it's not certain exactly how much that'll be worth when the deal goes through, if they do approve the Netflix offer.
Yeah, so many moving parts, as you mentioned. All right, which one actually faces fewer regulatory hurdles in the U.S.?
Well, we're looking at that in two different ways. On the merits, we don't think it's necessarily clear-cut who should have fewer regulatory hurdles. You mentioned about in the U.S., they've got different things that would be the potential hangups. For Netflix, of course, it's the multiple very large subscription streaming platforms. And so if you're looking at the size of the subscriber base, it would be huge. We think there's a good argument that's not the way it should be looked at, and that ultimately the deal will get through. Paramount has different issues. They've got 2 of the remaining 5 biggest studios in the world. They've also got the linear networks, which is probably less of an issue given that business is in decline. They'd probably get through too, but to us, the big wild card is how tough is the challenge, not necessarily on the merits, and that's where the relationships come in. It's been widely assumed that the Ellisons have a better relationship and would have an easier path with the federal government in the U.S. Now, the federal government doesn't have the absolute final say. They can't unilaterally reject or accept, but they can choose to not bring a lawsuit, not push back against it. And we think that's probably right, that the administration, that the Ellisons would have a better chance with the administration, and that there would be more pushback against Netflix, and Netflix would maybe have a more difficult, a challenging time getting it through. And for that reason, we think the Paramount offer is probably a little bit more attractive for the Warner shareholders.
Okay. Do you think Netflix will come back with a counteroffer, and has a date yet been set for a shareholder vote?
So at this point, we don't expect Netflix to revise its offer. The shareholders have now until January 21st to vote on the Paramount offer that's currently standing, and Paramount can extend that. We don't expect a vote on the Netflix offer until the second quarter. So Paramount probably has the first quarter to itself. It can see if it's receiving the shares that it needs, and if not, it may increase its own offer, and that's when we think it might be more likely that Netflix comes back. We think it would be a mistake if Netflix does, and they may decide it's just not worth it at that point. They can take the cash that they'd get for Paramount ending up rejecting its offer and going someone else. But it's possible. Like I said, I don't think that that'll happen unless and until Paramount increases its offer above 30. But you never know. Netflix has been more interested than we thought they'd be. And so I wouldn't take it to the bank. Every day is potentially newsworthy. Every day could be a gift that keeps giving. All right, Matthew Dolgan, thanks for joining us. Appreciate it. Thanks so much. Coming up, we'll have a look at record gold prices and the price of oil as well. Some more geopolitical risk on the table. Back in a moment. Gold and silver prices reached record highs today as geopolitical risks and anticipated Federal Reserve interest rate cuts prompt investors to shift away from some risk assets. Let's go to Bart Malik. He's Managing Director and Global Head of Commodity Strategy at TD Securities. Thanks for joining us today.
Great to be here.
So you had expected a $4,400 an ounce price at the start, next year. We're already there today. So are you changing your next year forecast?
Well, I think, we don't want to get too excited too quickly. When we're talking 4,400, we're looking at a quarterly average. And, typically there's a lot of volatility surrounding it. But we're also on the record as saying that with a $4,400 quarterly average, we could easily see $4,600, $4,700 trading peak levels. And I think we're still headed there over the next little while. The Fed continues to cut rates, and we are seeing continued interest in commodities as a diversifying asset in a well-balanced portfolio. That, at least according to a lot of portfolio managers and fund managers that we speak to.
Okay, so why are we looking at this year-end push for gold? Is this still central banks, you think, buying up?
Well, central banks have certainly provided a very good base. Ever since 2022, central banks have been aggressive buyers of bullion. They've been buying in 22, 23, 24, and 25 very strongly. They were buying well over 1,000 tons. We'll see how much it ends up being in 2025. But central banks, in my opinion, have a long-dated program to diversify away from the U.S. dollar and other fiat currencies. And that is something that they're doing. That's to protect against erosion of purchasing power because they're afraid of monetization, and also to increase, other assets and stability of their FX holdings.
Okay, silver also reached a record high today. Can you remind us about how or what kind of role it has in the AI data center build out, and what is your forecast for 2026 for silver?
Well, silver is extremely high here, certainly way above where we thought it would be at almost $69 an ounce. It plays a very instrumental role in, not only data centers, but all electronic industry broadly. It's a key component of manufacturing various components. It is a key component in electrification as well, particularly when it comes to solar panels. But look, at $69, I think it's a little bit overdone. At this point, there's we would say a gamma squeeze going on, where we're seeing a lot of option buying on the ETFs, and that's forcing some of the market makers to hedge. And that the way you do that is you buy the underlying, you buy the physical metal to protect yourself from the short positions you have on the call options you've issued. That's very inside baseball, but I think there's an element of that. And let's not forget the 232 provision fears. In essence, we're seeing a lot of illiquidity on the LBMA system, as traders don't really want to move anything ahead of any potential tariffs on silver and other precious metals under the 232 potential rules. Having silver already determined to be a critical mineral or critical metal, the concern is that there could be massive tariffs. And I think that's causing illiquidity all over the place. Earlier in the year, we've seen massive amounts of silver move into the CME system from the LBMA system ahead of the tariffs. As it stands now, tariffs have not materialized for bullion, and we don't think they will. But it's sort of paralyzing the market. Once there is some clarity on it, a lot of that illiquidity may go away, and we think that silver will likely trend significantly lower. But we don't expect it to be a massive rout, though.
Okay. What metals interest you next year?
Well, certainly platinum and palladium. Platinum is also up about 130% year to date. Palladium is up, I think, 70%. We like those metals because they are going to be, like silver, in a fundamental deficit. In essence, the amount of mined metal and recycled metal is not going to be enough to satisfy the physical demand coming from solar, the chemical industry, jewelry industry, and others for silver. And that is the same case for platinum and palladium, which are very much used not only as industrial metal broadly, but very much used as catalysts in catalytic converters for vehicles. And we've seen a very sharp decline and sentiment for EVs, where we don't think that EVs are going to have these hockey stick trajectories upwards. And we are now betting that standard ICE cars and hybrid cars, which all use very high loadings and catalysts, will continue to prevail over the next several years. And that means that both platinum and palladium are going to be in a deficit. And again, the story is with the 232 potential tariff provisions for PGMs, we're seeing a bit of a squeeze and illiquidity, which is causing, I think, a lot of immobility and lower inventories. That has played a huge role in lifting these markets higher.
All right, Bart Malik, I'm going to leave it there with you, sir. I'm out of time, but thank you for your time. Appreciate it.
It was my pleasure. Thank you.
So oil prices rose today due to increased geopolitical risk at the U.S. Coast Guard, reportedly now in active pursuit of a third vessel in international waters near Venezuela. And of course, it follows the recent seizure of 2 sanctioned oil tankers by the U.S. Let's go to Vikas Diavedi. He's a strategist at Macquarie Group and joins us now to talk some more about this. Thanks for your time.
All right, thanks.
Why are the tanker seizures not impacting crude prices as much?
The market is not viewing this yet as as nearly a big of an issue or a risk to supply as, say, the Iran-Israel and definitely the Russia-Ukraine situations. And the reason is it's just a much smaller amount of oil that would be at risk under any scenario.
Okay, so China primarily buys some of this oil, is what I understand. How much do they rely on it?
Yeah, so look, Venezuela exports roughly 700,000 barrels a day, and China is about half of that, call it 350,000 barrels a day. China imports about 12 million, right? So, it's a small amount, but it's an important part of a arrangement between China and Venezuela. So it's something we don't think the Chinese particularly are interested in seeing get disrupted, even though it's not a big part of their crude import picture.
Who else relies on Venezuelan oil?
Yeah, so if you say China is roughly 50%, the U.S. is about 20% of the exports that Venezuela puts out into the global market. And then after that, there used to be in the Mediterranean, and Spain in particular was a big buyer, but almost everybody else that was a big buyer is down now. And the rest of the other 30% that's not China and that's not the U.S. is just scattered around the world.
Is there precedent for what the U.S. is doing now with the seizures?
Are you saying, is this potentially a precedent?
No, I'm wondering if there is precedent for what they've done. Is there a legal precedent for the action they're taking?
I don't believe there has been of this particular variety. And certainly we've sanctioned vessels, we've sanctioned countries, and potentially using secondary sanctions buyers. But going after like a sanctioned vessel directly, certainly in my experience, we've not seen that.
Okay. Let's take a look down the road, because clearly, as you mentioned, it's not having a great impact so far. That could change if Venezuelan oil exports start coming into North America. We don't know what the long game is here. How could that affect both shale producers in the U.S. and then oil producers in Canada?
Great question. Look, in the long game, there's a couple of scenarios, right? One is everything sort of heats up for a few weeks, a few months, and then it kind of goes back to normal. There is no regime change, and there's no big overall change in the dynamic of Venezuelan oil, as well as their oil industry. So the export don't change, and the overall industry doesn't change. In that situation, you kind of are back to where we started. In another scenario, though, where there is something more dramatic, let's say it's regime change or something that restructures their industry. Venezuela, it wasn't that long ago, about 10 years ago, they were exporting over 2 million barrels a day, almost 3 times what they do today. And if they ever got back there, and they could, it's the most, really the largest oil reserves in the world, and they can get there with a restructuring of their industry. So if they got back to 2 million plus versus 700-ish right now, that would be a massive change to the global market. It would be a much bigger direct competitor, to your point, to Canadian crude. It wouldn't do a lot to shale. It's a different grade of crude, right? Shale is a light sweet crude. This is very heavy sour. But it would affect other heavy crude producers around the world, especially the other parts of OPEC.
So, Vikas, what's your oil outlook at this point? Because you have the situation with Venezuela, which is clearly not resolved. And as we mentioned, we don't know what the end game is here. What is your outlook for oil for 2026?
Yeah, we're still expecting a very large oversupply in the first half of the year. And we are still expecting a pretty large pullback in oil price, going through the first quarter of 2026 and into the second quarter. So, we can see the price going for Brent crude into the low 50s, maybe even below that, towards 45. Probably can't stay there too long because a lot of things that led to the oversupply will fix themselves if the price goes into that low 50s, mid 40s range. And so we're expecting, kind of a average for the year that's in the high 50 Brent. So not a big delta from today, but the path we think could be kind of wild, and wild meaning more downside before we rally back up.
And I should ask, does that include Russia, some sort of, agreement where Russian oil gets on the market in a legal way?
Yeah, we're not counting on that. We have cuts from the recent Russian production and export levels for the most of 2026. So we really are not counting on any big change upward in Russian supply to the market. To your point, there's a lot of peace efforts that are kind of rolling out and some progress being made. But we think by the time the oil is really able to come back in size from Russia, it'll be most of 2026 will probably come and gone.
All right, Vikas, I got to leave it there. Thank you very much for sharing your time. Take care.
Thank you. Okay.
Coming up, shares of NVIDIA rising today following reports the company may start shipping some of those chips to China again in the new year. Back in a moment. There are reports NVIDIA will soon start to ship its H200 chips to China. Washington has approved the sales, but this is the first we're hearing about a timeline, which is to start early next year. Let's go to Gil Luria, head of technology research at D.A. Davidson. Thanks for joining us today.
Thanks for having me.
So these aren't the most advanced NVIDIA chips. We know that. Is there still an appetite for these in China?
Absolutely. Really, all data center build-outs would love to get as many NVIDIA chips as they can, and that definitely includes Chinese companies that are trying to develop more advanced models for artificial intelligence and serve those models to a larger customer base. So really, any chips NVIDIA is making at this point have a customer. And that includes the H200s, which are really just one generation old. They're still very, very potent. And the Chinese customers, the Chinese companies, are very much interested in that delivery. The question is the Chinese government going to allow them to acquire these chips?
We'll talk about that in just a moment. The early estimate hit from NVIDIA was it was losing $5.5 billion when the Chinese market was locked out. Is that still how much business is expected from China? Have they changed that forecast?
Well, right now they're forecasting zero sales to China. But realistically speaking, the Chinese market is about a quarter of the global market. So if they could serve that, that would actually be a lot more than $5 billion, even a quarter. So NVIDIA is very much interested in being able to sell into China really any generation of chips that it's allowed to do so, because it is a quarter of the global market at least. And right now, based on their projections and therefore our projections, China is going to contribute nothing to next year's results.
Okay. You touched on this. China, we don't know whether Beijing is going to say, sure, bring them in, because China wanted domestically to find a workaround, right? They wanted domestic producers to fill in the gap. Were they able to do that? Were they successful?
Not yet. They will be eventually. They'll be able to develop chips that are comparable, and long term they'll be able to produce enough of them. But they're not nearly there yet. What the Chinese are really concerned about is that the U.S. Congress passed legislation that said that every NVIDIA server rack needs to be tracked to make sure that it doesn't get smuggled into China, so that the most advanced chips don't get smuggled into China, which the Chinese saw as backdoor spying. And so that the Chinese reacted very badly to that, which is part of the reason they wanted to halt chip shipments into China. So we're stuck between the U.S. not sure what they're willing to sell, China not sure they want to accept shipments if they have backdoor tracking, and NVIDIA is just caught in the middle trying to make all these sides happy. We believe that eventually they will, but right now we've been back and forth multiple times on this, which is why we're not celebrating yet. We're not including these shipments in NVIDIA's results, and we're going to wait until there's actually chips being delivered, because China is very protective, obviously. And longer term, China does want a domestic industry to produce these chips. But again, that's not the gating factor. Right now, they're producing as many chips as they can. They're buying as many chips as they can. The appetite for AI compute is still insatiable on both sides of the ocean.
Yeah, and they'd have to get on it now. They can't really sort of delay the build out and get behind. They wouldn't want to put itself in that position. Is it possible, and I think you answered it, that Washington will grant access to more advanced chips to be sent to China?
It seems like it's a negotiation, and the H200s, again, are very advanced chips. They're just one generation old. They're still probably better than any other chip anywhere in the world, so very advanced. And the U.S. government has already gotten its head around allowing that to ship to China, knowing that the next generation is going to be deployed in the U.S. and the U.S. will be able to maintain its lead. And let's not forget, President Trump decided that he's going to tax those sales at 15%. So this is going to be on top of the tariffs.
I think it's 25%, Gil. So there's a lot of money to be made. I forgot about that.
It depends on what day you ask him. You know, he seems to change his mind a little bit on these things. But yes, he will be taxing those chip shipments. It will be an additional source of revenue. Let's not forget, billions and billions of dollars, 15 or 25% is very meaningful income for the United States government.
Absolutely. You currently have a buy rating on NVIDIA. There have been concerns about AI spending and what the return would look like. Would you buy? So you'd buy today, even where it is at 183. I know the high was 207. What could change your buy rating?
So we share all these concerns. Will there be more scrutiny about CapEx? Will there be a challenge to get the return on investment required? Competition from other chips, especially from Google's TPUs and Amazon's Trainium. We share all these concerns. We just keep going back to there is insatiable demand for AI compute. We are going to need to build a lot more data centers with a lot more chips. And right now, that means almost entirely NVIDIA chips. And it's trading right now. NVIDIA shares are only trading at 26 or 27 times next year's earnings. That is below the historical range, which tells us that the market is fully anticipating the cycle to be over relatively soon. And we think that's completely fair. The cycle may be over in 2 years or 3 years. At 27 times, that's very attractive ability to buy what is still the core of the AI trade. Again, there is no AI without NVIDIA, and that's going to be the case for the foreseeable future.
We have been hearing different deals being done for different chips that are emerging. You don't have concerns around that?
So we will have other chips go into the data center. Google will continue to use its own TPUs. Amazon increasingly its Trainium chips. Everybody else is trying to make their own chips, but they're probably years away from that being successful. AMD might have somewhat of a helpful chip next year. But again, these are all very small parts of the market in a market that's still exploding beyond the ability to generate enough chips to fulfill all the demand.
Got it. Gail, thanks for joining us. Appreciate your time.
Thank you.
That does it for The Close today. Thanks for joining us. We'll see you back here again tomorrow.